Today, we're going to show you a comprehensive guide to buying commercial property in Australia. So Jaden, how much can I borrow? Is commercial lending so much different to residential lending? What do I need to know here?
Yeah, so let's start with the basics. With commercial, it's actually really determined by the price that you're going to buy, the price of the property. So if you're buying a property up to $1 million, the good news is you only need about a 20% deposit. So you can get up to an 80% loan. Now that's not across all lenders. Some other banks actually need you to have a high deposit, but generally speaking, up to $1 million, you can get away with about a 20% deposit. The difference is with commercial property, over $1 million, you're going to need at least 25 to 30% deposit minimum. In some cases, over $2 or $3 million, you actually need 35 to 40%. You need a huge deposit. But the fact is, commercial property, that's the risk. It's usually bigger prices, better yields, but you need to put in a lot more money up front.
So Jaden, what is a commercial property?
Yeah, so commercial property is pretty much anything that isn't your standard home. So the banks will consider, say, a warehouse, a set of shopping centre, a set of shops, a childcare centre. Even if you've got more than 3 residential properties in one address, they consider it commercial. So it's pretty much anything that's property related that isn't a home that you live in. And that's where the banks find them a bit more restrictive because there's more risk. Obviously, in a home, you've got the whole population of Australia that you can rent it out to. Whereas if you own a big commercial warehouse, there's not going to be as big a population of people that you can rent out the thing. So that's why they want you to have more deposit, and there's a lot more restrictions when it comes to lending.
So Jen, with commercial, I assume if I find the right property, it's getting enough of a yield, I don't need to show any of my details?
Yeah, nah. So with commercial, this is the mistake a lot of people make. They think it's like the old cowboy days of the 1990s where you find a place, you've got a deposit, you sign a load up form and you're away. And that's the case with some smaller commercial properties, but it's not the case in general. If you're buying commercial properties and if, like I said earlier, you've only got a 20% deposit, you're still gonna need all your tax returns, your pay slips, all the normal information to be able to get the loan with the cheapest rate and really the highest leverage. The good thing in commercial is, yeah, there are some that do low doc, which means that you only need to sign a tax declaration or give a BAS, or even no doc, and lease doc, which is just literally based off the lease. Now, the limitation with that sort of income verification is that it costs more basically. So because it's more risk to the lender, because if Nathan's just signing a form and saying, yeah, I'd totally make $1 million a year, they will price that for more risk and then they'll actually lend you less, so you'll have to put more deposit in. But in general, commercial is assessed pretty similar to how home loans looked at these days.
So Jaden, with a commercial loan, is it as simple as giving a few pay slips, my credit, tax returns, or what is it that I have to give?
Yeah, so it's actually completely different because with commercial lending, it's not just about you, the borrower or the sponsor, it's also about the asset and the person that's letting that out from you. So for example, if I bought a big master's warehouse a few years ago when they're in business, the risk isn't that warehouse and being able to resell it, it's actually about the tenant that's renting it from me and the income they make. So the banks put a lot more emphasis when you're borrowing on commercial property about the tenant, what they're doing in business, how experienced they are, how long your lease is. Commercial leases are very different from residential because instead of getting a lease for 6 months or 12 months, in commercial you usually get leases for 3, 5 and 10 year periods with further options to extend that. So I guess in summary, commercial is very different because it doesn't just look at you, it doesn't just look at your deposit, but it'll look at the property you're buying and also the tenant and lease profile to make sure that that's safe and secure for the bank to get their money back if something goes wrong.
So with commercial lending, I heard that you have to have an annual review. So why is that, Jane? Why do you need to do an annual review?
Yeah, so with a lot of banks, they'll require you to do an annual review every 12 months. So what that involves is they'll ask for your financials, they'll ask for a snapshot of your situation, you gotta get all your tax returns, a bit of a pain in the neck to be honest. And every couple of years, they'll want a new valuation of your commercial property. Now, it is pretty painful actually, because you got to get all that information together every year. That means you have to be doing your tax returns and it's quite frustrating. So the good news is that while most banks say with over $2 million of lending will need annual reviews, there are some small lenders that don't need that because they'll actually, instead of looking at a 3 or a 5 year loan term, they'll go up to 20 year loan term on commercial property. So there are a couple of ways around that. Just because your bank's pushing you for an annual review doesn't necessarily need to actually get one.
So Jen, I've got a commercial relationship manager who looks after me for all my lending needs in one of the big banks. Why would I go to a broker? Or is there any benefit to keep with my commercial banker?
Yeah, so I guess like with residential property, with commercial mortgage brokers, we get to see a lot more of the market and have a lot more options. The other interesting thing with commercial lending, and I used to work at a couple of banks, commercial relationship managers don't get paid on just doing deals, they get paid on the amount of profit that they make for the banks. So usually it's in their interest to charge you a bit extra because it actually goes towards how much their bonuses and how much they get paid. The other thing too, if that commercial bank is getting paid on the profit, they're not necessarily going to tell you about the better deal that another bank has down the road or another bank can do with lower deposit or higher gearing, and they can kind of get you trapped in there because again, commercial lending, unfortunately, is really opaque. It's not as open. You can't just go on Google and search for interest rates and bang, they come up. Because a lot of banks will say it's all price for risk, it depends on the asset, and it's a bit of baloney, to be honest. So that's what a mortgage broker can bring to you. We see these deals every day. We see lots of transactions, a lot of volume. We can get a lot more options than if you were going directly just to a bank. So that's it for today, guys. I hope you liked it. If you did, leave a comment below. And if you've got any questions, make sure you hit us up at huntergalloway.com.au.